You're all very welcome. Thank you for your time. And thank you for taking the time to fill out the questionnaire ahead of time. It's very useful. Can I start on the stress test? The piece that was failed by permanent TSB suggested for the end of last year's accounts a shortfall of 855 million under the extreme scenario. And you've made the point, Mr. Masding, that about 80% of that by now has been dealt with. Am I right in thinking, therefore, that if the stress test was rerun today, 20% of 855 is 171 million, that the extreme test would find the bank out by about 171 million? Is that what you mean by saying we've dealt with about 80% of what the ECB found?
If you applied the same inputs, the same model, prima facie the answer is yes. The capital plan that we've submitted, I would say the 171 is at the top end of my expectations in terms of where we'll end up as a net figure.
Okay.
But your logic is correct.
So the ECB ran the same test today. We would expect to see under the extreme scenario a capital shortfall of about 170 million.
If you applied the performance of the bank back then, where we are today, I just need to think. That's a good question. I just need to think about that.
Could I have?
Yeah, I think actually we might do better. Actually.
What will certainly always be the case is that the COCO would have to be deducted. So if you're looking at a gross figure of 855 today, on an equivalent basis, it would be 455. So what we're talking about is sort of covering 80% of the total, but that includes taking the COCO into account.
Okay, thank you. When do you think, it looks like things are moving in the right direction financially for the bank, when do you think the bank will be at a case where, were the ECB to run the tests, you'd pass that third test and the other two, obviously?
I think the whole idea of this very professionally run stress test, to be fair, I wouldn't want to be quoted on that, very professionally run stress test showed that at that point in time we will need some capital. The whole idea of it, as I think, is that next time they run it, we won't need any capital. So my expectation is we will get to, I think, a cycle of stress tests on the assumption that we bring the private capital in. If they ran the stress test the day after that private capital, we pass the stress test. Okay,
thank you. And moving on to the cost of capital, you said in your reply to the committee that your cost of capital is 174 basis points or 1.74%. And Mr. Lucan, you said, I think, that the ECB money makes up about 6 billion of that. Is that correct?
Yes, it's at a normalised level today of around 17% of our total funding.
Okay, and is that through the LTRO programme?
No.
No. Is there an opportunity? My understanding is that the ECB is making money available at less than 174 basis points, significantly less.
Yeah.
Is there an opportunity for permanent TSB to reduce its cost of capital by accessing cheaper ECB money? And is there anything that the state could do to help that?
I'll make a couple of comments on that. One is factual, the second one is a personal opinion. So the factual comment is, broadly speaking, our collateral isn't eligible for that new scheme.
Okay.
So I think it would be very difficult for us to have access to it, to be frank. Secondly, I have always felt that it was best for the Irish taxpayer and the Irish state that we took permanent TSB back to a simple, well-governed, well-managed and safe bank. And by that I mean we have deposits on one side of the balance sheet and we have good lending on the other side of the balance sheet. And I think the ECB in our case would be extremely supportive of us driving for that business model. We were overexposed to the ECB in the past. I go back to the loan to deposit ratio, the capital markets close, you fill the funding gap with ECB. I think they would be extremely nervous, certainly over the next few years, if permanent TSB gouged itself again on ECB funding. So hypothetically, you're right, it's cheaper funding. But in terms of the long-term safety of this franchise, I'm sorry to be old-fashioned and a bit boring, but I want a deposit-funded, safe retail bank.
Okay, so you are sufficiently exposed, is what you're saying?
Yeah, We could get more probably if I really tried, but I don't think that would be the right thing to do for the customers and for the taxpayer, to be honest with you.
Can I ask you, the margin that you were referencing earlier on was 88 basis points, if I remember correctly.
Yeah.
You said that it's higher for the core bank.
Yeah, that's right.
Are you allowed to say what it is for the core bank?
Yes, yes, of course.
It's 121.
121, okay. How does that compare to the UK? Are you
So
higher, lower?
Oh, way lower.
Way lower.
A well-run, well-governed retail bank should have a net interest margin. My guess somewhere between 160 and 180 would be my guess.
Okay.
So let's call that 170.
And are you trying to move there?
Absolutely.
That 121 is increasing, is it?
Yes, absolutely. Yeah. But just to be clear, obviously the net interest margin is a function of both what you charge for lending and how much you pay for deposits. We still pay a premium over the other banks for our deposits because we haven't got a restructuring plan and because of historic issues. Our cost of funds line is probably the more important of those two lines.
Okay, thank you. I'd like to move on to the sale of Springboard. So Springboard is it fair to say a subprime mortgage loan book? That's what it was?
Yes, that would be a fair description, yeah.
And that's been sold now to Mars Capital for 468 million this year. That's correct?
Sure. So the gross loans were 468 million.
Well, that was the size of the loan book, sorry, okay. Can I ask, while the loans were within Permanent TSB Group through Springboard, they were protected because Permanent TSB and Springboard is a regulated entity, and therefore the CCMA applied. Does the CCMA apply to Mars Capital, or is that an unregulated entity operating within the state?
A condition of the sale was that Mars Capital would honour the CCMA, and they were quite happy to do that. So the borrowers in Springboard under their new ownership have the same protections as they had with PTSB Group.
Okay. And what guarantee does that? So first of all, is Mars Capital, I'm sorry, I should know this, I don't. Is Mars Capital a regulated entity within the state?
I'm not sure technically, but I know it's certainly it's an intention for Springboard and other books that it runs is to operate as if it were.
Okay.
Technically, I'm not certain myself, but it has committed that it will work to the CCMA.
Okay. And what form does that commitment take? Is it a contractual agreement? Has it got legal strength?
So at the moment it doesn't, but the legislation is changing, as you'll be familiar, to protect borrowers in situations like this, and to date, as part of the agreement, the commitment was part of the deal that we weren't prepared to take any bidder into the bidding process unless they gave us a commitment up front to honour CCMA.
Okay, and you have that in writing, do you?
We do.
Thank you. I'd like to go on to the mortgages, the distressed mortgages. One of the things I was quite surprised to see in the numbers supplied was that there haven't been any mortgage to rents from Permanent TSB. Is that a policy decision of Permanent TSB not to do them, or, and if not, why is the number 0?
So there's actually been one case done, and that's very disappointing from our point of view, to be quite honest. It's the one customer treatment that we don't entirely control, and there are a number of parties involved. And I think last time we were here, we did express some level of frustration with just how that product or that treatment is operating. There has been significant progress since then. There is a working group that comprises members of the BPFI, the Department of the Environment, the Housing Authority, and the approved housing bodies. And so collaboratively, we're trying to knock down the obstacles that exist at present. Okay. So I'm hopeful that that will improve.
Thank you. Thanks, Chair. Can I ask, are all splits, is the shell portion on all splits at 0%?
So on the home loans, all of our warehouses attract no interest.
Yeah.
We're the only bank I understand that offers splits to buy-to-let customers.
Right.
We have a small number of buy-to-let splits, and the warehouse on those products attracts a nominal amount of interest.
What is that?
So it varies case by case, but The vast majority will be less than 1%.
Less than 1%. Thank you. Do you have any debt for equity solution?
No, we don't. We've considered a number of options on the back of the meetings we've had here in recent times. We listened previously to a suggestion about extending our current treatments into retirement. We've investigated that with our credit committees and with other forums, with customers, and we believe that in hindsight there is merit in that. So we have decided to progress that particular customer treatment. And we also spoke to you previously with regard to making and giving commitments up front to customers who work collaboratively with us to sell their property as to what might happen to any shortfall that might arise. And we've decided to implement that as a proposition. And the debt for equity we haven't pursued at this stage. Our sense is that it's a complicated proposition, and there may not be as much appetite among our customer base for that proposition as there would be for commitments up front to shortfalls and lending into retirement.
Okay, well, thank you, Chair. I'll finish with this comment and say I'm delighted to hear that. I'm delighted to hear that some of those things are happening. Can I ask you to take a look at how AIB uses the debt for equity solution? Because it's using it, I think it's more applicable, but it is using, the first place it's used it and it's working is on retirement. So you have a split mortgage. So let's say you have a couple at 60 years of age, they're 6 years away from retirement. They get a split, which allows them to live in the house, live with dignity in the house up to 66, 67 years of age. And AIB are then doing a debt for equity on the amount that's required to bring the total borrowings down to allow them to stay in the house. Without that debt for equity portion coming into play at retirement, it's very, very difficult to restructure the mortgages for the lifetime of the people. So could I ask you to take a look at how AIB is successfully doing that? I welcome the fact that you're bringing in those other measures. Thank you all very much.
Thank you, Dan.
Thank you, David.